The next form of liquidity is time-based liquidity. So this means areas of liquidity that are a result of time in the market, okay? So this comes in two forms: session range liquidity, as well as previous daily highs and lows, okay? The reason for this is because we have to view areas, or windows of time rather, as whether they include institutional involvement or not. So Asian range, for example, has institutional involvement. The London session has institutional involvement. The New York session does as well, but the thing about New York is that there's no session following New York. Okay? So we don't look at the New York session range as closely, because after that is spread hours. It's central banks dealer range, it's called, and it's very low, it's very thin liquidity, so we don't look at that either. But what we look at is the Asian range and the London range. So with the Asian range and the London range, we can look at areas based on the highs and lows of those ranges as areas that could potentially get manipulated into and then reverse price. For example, here we see an Asian or a London session high here that pushed down price and gives us this range from here to here. So we can expect a manipulation outside of this range to push us in the opposite direction. So an external range liquidity manipulating, institutions manipulate price above this level and hit stop losses, and then push price in the intended direction. Something very important about this is that we only look at this if it is in line with our bias. So if we expect lower prices, we'll look for a manipulation of the high to take us lower. If we expect lower prices and price pushes below the low, we ignore it because it's not in line with our bias. If I invert the chart now, for example here, if we expect lower prices from here, we can manipulate a high above this and expect lower prices and potentially look for trades. If we expect lower prices, and this is the low, and we manipulate above here, we are expecting lower prices, therefore we do not look for trades, okay? So must be in line with our bias. And that is the Asian session range or the London session range. Next, we have previous day's high and lows, okay? So on the daily chart, go and mark out the high and the low of the day, of yesterday. We're gonna look at that area as a potential area of liquidity. Just like the sessions, we need this to be in line with our bias. So if we have a bearish bias, expecting lower prices, we can view this as a signal or a cause for lower prices, as we call it, right? So this previous daily high, as it's above, is a form of what kind of liquidity? Buy side or sell side? Buy side liquidity. You can see this as an area of buy side liquidity, expecting lower prices, and if that's in line with our bias, when we come above there, we can then view that as a potential area of manipulation, which will be followed by a distribution of price. That is a hit of stop losses, okay? On the opposite side, if we expect higher prices, we can view the previous daily low as an area of liquidity. If we hit that area of liquidity and we start to see signs of a reversal, we can then ride that momentum or ride that order flow as we come take out a high. If we have a bearish bias and we take out a previous daily low, but we have a bearish bias, then we disregard it. If on the opposite side, we have a bullish bias, meaning we are expecting higher prices and we take out the high, we ignore it because we're not looking for shorts. Okay. If we do try and trade this, but we have a bullish bias, we're in a bullish trending market, you can easily get caught on the wrong side. So all of your liquidity analysis needs to be in line with bias and structure.